our decision for finding that ideal mix of debt and equity as a company, right? There are multiple factors that we need to consider. Obviously, the most important one is to minimize the overall weighted average cost of capital. And we will talk about the theories that exist, such as the Modigliani and Miller 1958 theory, and then the 1963 theory, and then the current static trade off theory, that how an increase of debt in your overall capital structure can, to certain extent, lower your weighted average cost of capital, right? But before we do that, let me just explain what this other part of this sentence is saying generally matches the duration of their assets. So if, for example, the 100 million on the asset side is being used for a long term investment, right? Then we would want to use common equity, preferred equity, and if within the liability side, we would like to use maybe bonds with a long maturity, maybe 10 years, if this is a very long term investment. So, the maturity of the asset, the life, the time it will take to get the investment back is what will definitely impact the decision that how would we like to finance that investment, right? Because if you take a very short term bank loan which you have to pay back within, let's say, 2 years, right? And the investment you have made is for like 10 years, so that makes absolutely no sense, right? The second thing we need to consider is where the company is in terms of its life cycle, right? Is it a startup? Now, startups obviously are very young companies, and their cash flows are not very positive if they have any revenue at all, right? When they get into the growth phase, maybe the revenue has started, but the expenses might still be more than the revenue. So the cash flow is probably still not positive. And then finally, they get to the mature phase where you will have positive and stable cash flows, at which point banks will be willing to give them loans. But before that, since banks are not willing to give them loans unless they have some very good collateral to give in terms of some real estate or some other assets, banks might not be willing to give them a loan, and bondholders might not be willing to invest in their bonds, which means they, even if they want, they cannot increase the weight of debt in their capital structure, and they will have to probably entirely finance their business with equity, especially when they are startups, and then primarily with equity when they are in the growth phase. And lucky for them, there are venture capital companies which provide this type of equity for startups. So, a life cycle stage is something which is definitely what impacts the choice of your capital structure, right? Because naturally, if you don't have the ability to support debt, then you cannot have debt in your capital structure. And as you move from a startup towards being a mature company, your operating cash flows turn positive, become stable, predictable, and this allows you for a greater use of leverage. And we're talking about financial leverage over here, which means you can increase debt. Now, I would like to explain this term leverage so that your concept is made right from the start. So, asset of 100 million, right? Liability of, let's say, 50 million, and equity of 50 million. This liability, this loan that we have taken from the bank, stays fixed. If our assets go up, let's say we made a very good investment, now assets have gone up to 200 million. Does the bank loan also go up? No, it doesn't go up. So that is fixed. Of course, you have to pay an interest on it, but the principal amount stays fixed. and the equity really benefits from the increase in assets. So when you have something fixed, that is what we call leverage. And here, because it's related to the financing of the business, we call it financial leverage. There is another type of leverage that is discussed in different other learning modules, where, and even in this one to some extent, and that is called operating leverage, and that is not financial leverage, right? So in terms of your, let's say, business, you have, let's say, certain amount of sales, and let's say this is your profit. Now if a significant amount of costs are fixed, so as your sales goes up, your profit might go up exponentially, right? Because not every cost is variable. There's going to be fixed costs, and then there will be variable costs which will go up with the business. So as sales goes up, right, sales might be going up like this, but for each additional unit of sales, the variable cost is probably less. So the difference between these two, as you can see, is exponentially going up. And that is where your profit is exponentially going up, because some of your costs are fixed. Similarly, when we talk about debt or bank loans, they are at a fixed cost, right? So as the business grows, as the assets grow, your equity gets the benefit of that. And similarly, when we talk about operating leverage, other costs such as maybe the rent of your factory or the rent of your office is a fixed cost. As your sales goes up, your profit goes up exponentially. So this leverage can be operating and financial as well. Right now what we're talking about is financial leverage. And yes, companies would like to increase their financial leverage to benefit from the growth in their assets exponentially in your equity. But when you're a small company, when you're a startup, you can't do that, right? Nobody's going to give you that fixed debt. The bank is not going to want to give it to you because, first of all, there's no revenue coming in, right? As you can see from this extract from your curriculum, Exhibit 2, there's no revenue coming in. And there's negative cash flow because you're having to pay for whatever expenses that you have. It's not until you enter the growth phase that your cash flow becomes positive. And that is even somewhere halfway, or the two-thirds or maybe one-third through your growth phase that it becomes positive. And then the bank would feel comfortable giving you some debt, right? So what's happening with the startup phase? The revenue growth is very initial, right? Cash flow is negative. Even till the end, it's still negative, right? This is where it becomes positive in the growth phase. So cash flow is still negative. Business risk is high. Debt availability is none, right? Why the word little? Because even the debt that you might get is actually just equity. It's convertible debt, which means it can be converted into equity. And the investor, whoever is giving you that debt, probably has accepted that, oh, this can be converted into equity. So it's more of a equity investment, that they have the risk appetite for an equity investment, but they are giving you debt because they would like that safety. In case of bankruptcy, they would like to get paid first. And in case of no profits, they would at least want that fixed return. Only when you get to the growth phase does your revenue start going up, does your cash flow start becoming positive, right? Business risk goes down, debt availability starts rising, right? But still, you need to give good quality collaterals. That could be real estate, that could be your account receivable, depending on who are your customers. If you're supplying to the government and you have receivables from the government, you could use that as a collateral to get loans. And then finally, when you get to the mature phase, your cash flow is stable and positive, right? So that is where your business risk becomes low, your debt availability becomes high, and without any kind of collateral, unsecured debt. And that is what is discussed in these slides, that a startup has revenues close to zero, right? You're still in that prototype phase, moving towards commercial production. Cash flows are negative, risk is high. You would definitely need to fund yourself with equity. Good for you that venture capital funds are there, angel investors are there, and debt is not available. Even if it is, it's going to be very expensive. So, therefore, it is a negligible component of your capital structure. You might be able to raise convertible debt, which is convertible into equity. In the growth phase, now you're trying to become stable, your business is becoming a little bit more predictable, risk is going down, right? Cash flow is still negative, but it becomes positive through this phase, and you might be able to get some debt at some terms, not very good terms, but reasonable terms. However, you may have to give your assets as collateral, right? Real estate or account receivable. But would you want to take on a lot of debt at this stage? The answer is no, right? And most companies in this phase of their life cycle actually use debt conservatively because they want to retain their operational and financial flexibility. So even here, like the startup phase, even in the growth phase, you would have equity as being your main source of capital. Once you're mature, now your spending goes down, your revenue goes up, your cash flows are positive and stable, predictable, risk is low, and you are easily able to get debt on attractive terms without any collateral. And you would want to take on that debt as well because it lowers your cost of capital. It lowers your cost of capital because debt comes at a lower rate and it gives you the tax benefit. So you would want to do that. Uh, Sometimes what happens is that your share price starts going up, and because of that, the market value of your equity goes up. So even if you're trying to increase the weight of debt in your capital structure, your weight of equity is just automatically going up as your share price is going up. So then you might have to keep adjusting that, right, on an ongoing basis. So to offset this automatic deleveraging, what you would have to do is reduce your equity by either paying dividends or buying back your shares. There are both ways to give money back to the shareholders, right? So let me explain that to you. Let's say you have assets of 100, liabilities of 50, equity of 50, and your assets go up to 200. Your market value of equity goes up as well because your company is doing well, right? So the share price is going up. Now what you can do is you can take some of this 200 and pay it to the equity holders, right? So you can pay, let's say you can pay a dividend, you can pay out a dividend of 100. So this becomes back to 100 and this equity goes down back to 50. Or you could use that money to buy some of these shares back and cancel them. Either way, your equity will go down and you can then reduce the weight of equity in your capital structure. Now, what does this line mean? Share buybacks are preferred over cash dividends. So if you pay a dividend, everybody will get that money. Some shareholders might not want cash right now. So the advantage with share buybacks is that when you buy back the shares and you cancel them, if you remember from your financial statement analysis, the calculation of EPS, and let's just say basic EPS, is net income minus preferred dividend divided by weighted average number of common shares outstanding. And when the number of shares goes down because you bought back some shares and you canceled them, the EPS goes up, right? Because net income is the same, denominator goes down, EPS goes up. And when EPS goes up, usually in the market, if the earning per share is going up, the price per share also goes up, usually, right? Investors generally respond favorably to a share buyback announcement, which leads to an increase in the share price. And coming back to the investors getting money, so let's say some wanted cash, some didn't. So the ones who wanted some cash can sell some of their shares and manufacture their own dividend. and the ones that didn't want cash, they don't have to sell their shares. And if you don't sell your shares, you don't pay any tax, right? So, but if you actually pay dividends to everybody, then whether or not they wanted cash, they would have received cash and they would have had to pay tax. So share buybacks are more tax efficient. Number one, because, well, if you don't need cash right now and a company is doing share buybacks, so the share price is going up, but you don't need cash right now, so you don't sell your shares. And if you don't sell your shares, you don't have to pay tax on them. Number one. Number two, capital gain tax rate is also less than the income tax rate. So on dividends, you have to pay income tax, right, which is higher than on capital gains. If the share price goes up, you pay capital gain tax, which is lower, and it could be substantially lower depending on how long you hold the shares for, right? So the longer you hold them, the lower the tax rate, the capital gain tax rate. So that is why companies prefer share buybacks and investors also prefer share buybacks over cash dividends. Right. So there are two exceptions to the discussion we just had about life cycle. Now, capital intensive businesses are those that even when they are a startup, they will get debt easily because their assets are so good, they're capital intensive, that even as a startup, they can get debt. Think of real estate companies, right? Where even as a startup, they can easily get debt because they're building a mall. And that is prime real estate, so the bank will give them a loan the minute from the first day. Capital light businesses such as software companies, even when they are mature, might not need debt, right? Because they probably become positive cash flows very early. So capital intensive businesses like real estate, like a mall, right, or a shipping company, utilities, airline, anything which has very, very good quality assets which they can use for getting a good they can use as good collateral for getting a loan from a bank easily at the very beginning of their life cycle. And they would like to use that, right? They would like to use that because usually in such safe, stable businesses, the return, the IRR in these investments is relatively low. So to increase the return on equity, what they will do is they would want to have, let's say, let me explain this to you. So let's say if you have 100 million of assets, right? And what the IRR you're earning on this is, let's say, 10%, and the bank loan you can get at 5%. So the more you use 5% capital to fund this 10% investment, is the higher the return you can generate on your equity, right? Because the cost of debt is lower than your return. So if you use more and more debt, you will be leveraging your equity return and it will become higher. So they would like to do it from the very beginning. Capital light businesses, on the other hand, they never really need to raise that much amount of capital, and even in later stages, they tend to use very little debt in capital structure. Now, so coming to what is the cost of debt and equity for different businesses, right? If depending on what you're going to do with that 100 million, the bank and the stockholder is going to then say, okay, do I want a higher return and do I want a lower return? Now, coming back to our discussion about the common equity, and we talked about something called the capital asset pricing model, right, which is discussed in detail in your equity section. But I did tell you a little bit about this, that the return on common equity, right, is a component of it. It's calculated as the risk-free return on the bank, because the equity holder will say, hey, at least give me the bank rate plus a premium. And that premium comes from something called beta multiplied by what the stock market earns over the risk-free rate. And this beta is actually a measure of systematic risk. Now, all of this will be discussed later in equity, but what I'm trying to explain to you is that whatever rate you will have to pay to your common equity or your preferred equity, right? And whatever rate you're going to have to pay to debt holders is going to depend on risk that you are taking in this asset. Now, that risk is going to include both the overall risk in the economy, right, and the specific risk that you are taking. So let's talk about debt. Usually what happens is that, let's say you're in London or you're in Dubai, right, and you want to take a loan from a bank, and the bank will say, hey, there is a Emirates interbank offer rate, which is the benchmark rate, plus they will say 2%, let's say, on top of that, if you're relatively not that risky. If you're a very risky company, they will say plus 4%, right, or plus 6%. Similarly, in London or outside of the US, it's LIBOR. So LIBOR plus 2% or 4% or 6%, right? In the US, it will be the federal funds rate as the benchmark, or we also have something called the secured overnight funds rate. Again, you'll learn all about this in fixed income, but whatever is the benchmark rate plus a spread, right? Plus a spread depending on how risky you are as a company. And the benchmark goes up and down as well. The benchmark goes up and down as well depending on the overall economy, right? So if the Federal Reserve is increasing the interest rate, the benchmark will be going up. But if there is a recession, then the spread will be going up. So the spread tends to widen during recessions, whereas the benchmark goes up and down because of the overall business cycle and what the Federal Reserve is doing and the Bank of England is doing and the European Central Bank is doing, and so on and so forth. Right. So a very good example of issuing debt when it's less expensive is Amazon. Just, I think, 2 years back, Amazon issued the cheapest debt in US history, right? So you can look it up. Amazon bond issue, cheapest in US history. And this was when the interest rates were really low. This is before the Federal Reserve started increasing the interest rates. So almost, I think it was 2021 that this happened. You can look it up. So that happens, right? Even though maybe at the time Amazon didn't need the debt, well, definitely they didn't need the debt, but they still issued so much debt because the interest rates were very low, and they secured the cheapest possible capital, and it is the cheapest in US history. So you can look that up, right? So sometimes that happens, that companies increase the use of debt because it's just so cheap to do it. Right. Now, coming back to the issuer specific factors, that why do investors feel that you are risky as a business, right? Why your beta will be high. And what is beta is something we will discuss in equity. But why will the bank say, okay, I'm going to ask you for 4% on top of the benchmark rate? Why? Why 4? Why not 2? Why not 6? Right? So it depends on your business risk and your financial risk. So overall risk. What is the stability of your sales? How stable are your profit margins? How much debt do you already have in your capital structure? What is the quality of the assets that you have? So starting with sales, Vodafone is subscription oriented revenues, so very stable, right? Even in a time like COVID-19 lockdown, people were still paying their subscriptions. But Toyota, or any kind of consumer discretionary, is what we call this industry, where there is a discretion of the consumer to buy or buy the goods. And obviously, they're not going to buy them in a recession. Nobody buys a new car during a recession, right? Hardly anyone. So it is more sensitive. These type of sectors are more sensitive to the business cycle. We call them cyclical industries. And this is obviously going to be a negative, which means higher risk. Profitability is related to your profit margin. Now again, remember I told you that how your sales goes up, certain costs are fixed, certain costs are variable, and your sales might be going up like this, right? Let's say this is your volume. Sorry, did I write sales earlier? This is volume, and this is dollars, right? So sales might go up a lot, and you can see the profit is increasing exponentially. But if it comes down, it decreases exponentially as well, right? So your profitability with respect to sales goes up exponentially, but then comes down very fast as well. So how stable is your profit margin, right? How stable is your profit margin? And think of it in terms of a company which is like Uber, right, or Airbnb. I mean, they have a certain fee per order, so right. It's not like their fixed cost is getting. They must have some fixed cost, but they're probably so negligible that at all levels, after their fixed cost is covered, they're having certain amount of stable profit margin per ride or per stay. But then you have companies like, let's say, American Airlines, right? Or let's say within the tourism space, Hilton. Now, Hilton or Marriott, they will have fixed costs. And if people are not flying or not staying, then their profit margins could really take a hit. So, this is basically your operating leverage, right? And companies with high fixed cost have a high probability profitability risk because their profit goes up exponentially, but it also comes down exponentially. Next is financial leverage. So how much debt you already have in your capital structure, because if sales goes down, you still have to pay that interest, right? And if you're unable to do it, then you might go bankrupt. So already firms with a lot of leverage are at high risk. Their financial risk is high. So again, when we talk about risk, there's business risk that is related to your fixed costs, and there's financial risk that is related to your interest or financial leverage. This comes from more debt in your capital structure. So financial risk is related to your capital structure. More debt means higher financial risk. And the business risk is related to something called your cost structure, where more fixed cost means higher business risk. And then the fourth point here is, of course, the quality or the type or the quality of assets that you have, right? So we want assets that are either strong collateral, easily liquidated, easily converted to cash, right? Easily converted to cash without much loss in value, or they generate cash, right? So their value is safe and easily they are able to be converted into cash, such as good real estate, automobiles, aircrafts, receivable from credit-worthy customers like the government. So the better the quality of the assets, the less the risk and the less the required return on that capital component. Right. We'll take a break here and then we'll come back and start our discussion about the various theories. So we had these two economists, Modigliani and Miller. They came up with a theory in 1958. Then they came up with another one in 1963. And then we have what is called the static trade-off theory now. And we'll discuss all three of these as we move towards the optimal capital structure.